When evaluating commercial real estate, investors often get caught up in flashy metrics: cap rate, internal rate of return, gross rent multiplier, and even appreciation potential. But at venusventure.us, there's one metric we never overlook, no matter how attractive the deal looks on the surface. Net operating income, or NOI. In fact, NOI is the foundation of every deal we evaluate, whether it's an underperforming retail strip, a value-add multifamily, or an industrial asset in a secondary market. NOI tells the real story. Here's why it matters more than anything else, especially for a disciplined, performance-focused firm like ours. Net operating income, or NOI, is the income a property generates after all operating expenses but before debt service and taxes. It includes rental income, parking, laundry, storage, and other ancillary revenue. Okay, so minus maintenance, property management, insurance, property taxes, and utilities. Now, what doesn't it include? Well, it doesn't include mortgage payments, interest, or income tax. This makes it, honestly, the purest indicator of a property's true income potential. In commercial real estate, property value is driven by income, not comps. That's why buyers and appraisers use this formula. Value equals NOI divided by cap rate. If NOI goes up, so does the value, regardless of all that market noise out there. That's why we're, laser focused on deals where we can grow NOI through things like rent increases, reducing operating inefficiencies, better management, and value-add renovations. Some deals look really attractive based on cap rate or price per square foot. But when you dig into NOI, the truth comes out. If a property's expenses are just too high, or the income is artificially inflated by one-time lease-ups, then the real performance is, well, pretty distorted. NOI forces us to cut through the fluff and really assess whether this property can stand on its own. Since we aim to refinance or sell within a few years, growing NOI is, honestly, non-negotiable. We underwrite with a clear plan to increase income, improve expense ratios, and stabilize cash flow. That growth allows us to increase value and secure favorable financing in the future. At venusventure.us, every potential deal is modeled around current and projected NOE. We answer questions like, what's the actual stabilized NOI based on market rents? Can we improve NOI by 30 to 50% in 12 to 24 months? And how does our projected NOI growth support our target IRR? So we also compare properties based on net operating income per square foot, which, gives us a deeper understanding of income efficiency, especially when we're looking at different asset classes or markets. So, not too long ago, we took a close look at a property in a pretty popular secondary market. At first glance, honestly, it didn't seem like it was underpriced at all. But then, when we dug into the numbers, we saw its net operating income was, well, really suppressed, mostly because of poor management, inconsistent billing, and way too much vacancy. After running our model, we figured out that if we brought occupancy up to 95% and tightened up those expenses, we could actually double the NOI in about 18 months. That one insight, it gave us the confidence to go after the deal. And we got it under contract at terms that lined up perfectly with our long-term strategy. In a high-interest, high-volatility market, a lot of investors are chasing short-term trends. But honestly, we're playing a totally different game. At venusventure.us, we focus on what we can actually control. And for us, that always starts with growing NOI. Here's the thing, it's the one metric that doesn't lie, doesn't swing with emotion, and yet it directly correlates to long-term returns. So hey, want to see how we underwrite deals in real time?